Stocks are financial commodities and have characteristics refer to the Companies Act of your country. The initial public offering constitutes the primary market. After that, all subsequent purchase and sales of the scrip constitutes the secondary market, and this is where stock trading actually takes place. In other words, the stock market or the equity market is made up of buyers and sellers of issued stocks. Secondly, the main purpose of issuing stocks is to raise capital for the company. Hence, stocks constitute part of the company's fund or the capital fund. Third, the market price of stocks are determined by the supply and demand factors. The supply of stocks are determined by the Securities Regulatory Authority. The demand for stocks is more volatile as it is dependent on the trust that the buyers have on the company, their future expectations of the company, the performance of the company, the stock price trends, and the actual sales and profit situation of the company, to name but a few parameters. Purchasing shares are not physical transactions as in a usual purchase order. Stock trading are financial transactions. There isn't any commodity that is being purchased and sold, as you know. We have already learned that buying a share represents contribution to the capital of the company. Hence, if a person owns a large number of shares, they become eligible to vote the members of the directors committee. In fact, owning more than 51% of the shares of a company is as good as owning the company. Demand and supply are the main determining forces of the stock's price. If demand sees a rise, it is likely that the stock is not available or is available at a higher price. In the event demand falls as investors look for other options, the price will also decrease because of the supply being more in this situation. The table gives the correlation between supply and demand, which is expressed as the market capitalization. You will be coming back to this reference point at all times during this course, analyzing the short-term and the long-term price expectations of the stock. How does the trader book profit in their transactions? Every trader buys stocks at a lower price and aims to sell the stock at a higher price. The price differential between the purchase price and the sale price gives the profit margin to the trader. As we are fast moving ahead in this course, my dear students, important points that you should keep in mind always. In investments, the methods and techniques that have been suggested and that you will be using are useful, not foolproof. So therefore, you will always be needing to track your trades and track your investments. Failing to manage your own risk will be very difficult even for seasoned investors. The second point to note is that you should have a portfolio in your investments. Concentrated investments are a risky business. The third point, and another important point to note, is that emotions can cloud your judgments when it comes to business deals. So, you as a trader should never overestimate your abilities. Overconfidence has even cost many times the best investors billions of dollars. Reducing errors due to greed and fear are really vital in investment success. This course helps you to choose the appropriate time to buy and sell stocks, the profit opportunities in the stock market,